let's discuss cash dividends today, the beneficial kind of dividend, because with stock dividends, you're literally just getting nothing. It's just basically an accounting trick, essentially, sort of like a stock split. So when it comes to cash dividends, that's like the version of income that you get from stock, whether it's common stock or preferred stock, as opposed to interest from a bond. So with bond interest, it's always going to be taxed at ordinary income unless it has some tax advantages like territory bonds or muni bonds or even treasuries. Treasuries being exempt from state and local taxes, and munis being exempt from federal taxes and potentially state and local. Yeah, but when it comes to dividends, they can either be taxed at ordinary income or what's called qualified dividends, which are taxed at long-term capital gains. Unless it's like for a REIT, those dividends are always going to be ordinary income because they have beneficial taxation under subchapter M. But I don't want to get too far ahead of ourselves. So let's just discuss common stock dividends. So there are stocks that people purchase for capital appreciation or growth, something like an Nvidia, and then there are stocks that you purchase for income, something like a Coca-Cola. Blue chip companies that are, mainly established, have been around for a long time. I mean, Coca-Cola, obviously it's a very successful company, but do you anticipate Coca-Cola doubling in the next couple of years? Probably not, but Nvidia can. So that's really the difference. High growth stocks, compared to potentially like a value stock or some blue chip stock that pays you a high dividend. Sometimes they call it dividend aristocrats. So in terms of a lot of people remember the order of the dates as DERP. I don't know if I particularly like that acronym, but it is a popular one, so might as well discuss it. That's going to be the declaration date, the X date, the record date, and the payable date. So the D, the R, and the P is going to be decided by the board of directors of the company. Now, the X date is going to be decided by either the New York Stock Exchange, if it's on the New York Stock Exchange, or by FINRA if it's over the counter. So what does that actually mean? So the stock is going to announce a dividend, right? That's going to be the declaration date. Then the record date is the last date that you have to be on the books to receive the dividend, and the payable date is when you actually get it paid. In most cases, the X date is going to be on the record date. Now that settlement is T+1, meaning that the transaction actually closes one business day afterwards. So meaning, if you purchase the stock on the record date, by the time you're the owner, that means that, the dividend is already decided. So the seller would receive the dividend, not you as the buyer. Now, if you settle what's cash settlement, that's done within the same day, right? That's done within the same day. And then basically the X date would become the day after the record date. So it'd be more like DREP rather than DERP. So that's why I don't always like the acronym. Nevertheless, it's a good, little trick to remember about, who gets paid and so on and so forth. And on the X date, the stock gets reduced by the dividend. So there's orders that are, below the market, like a sell stop or a buy limit order are going to be reduced unless it says DNR on the order, because obviously that would kind of manipulate the price. So now, when it comes to the taxation and, qualified dividends versus regular dividends that are non-qualified, I sometimes I don't like using that word because when I think about qualified, I think about like qualified retirement plans and ERISA and stuff like that. But so qualified and just, dividends that are taxed at ordinary income, regular dividends. So in order to be considered a qualified dividend, it has to be like an appropriate U.S. company or foreign company. I wouldn't worry too much about the details of that. But the other key is that you have to own it. So if you take the X date, right, consider that one day. And if we're talking about common stock, if you go 60 days after the X date and 60 days before the X date, that period of time would encompass 121 days. So if you hold the stock 61 days during that 121-day period, you qualify for long-term capital gains. So that's extremely beneficial because if you're taxed at ordinary income, the max tax rate is currently 37%. With long-term capital gains, the max tax rate is 20%. And that's like if you're in the 34-37% tax bracket. Otherwise, you're likely going to be paying 15. And then I believe it's like if you're under 50,000, you get taxed actually at 0 for long-term capital gains. It's the same taxation as if you were to hold an asset for a year and 1 day. Also, another parallel is when we talk about current assets on the balance sheet compared to long-term assets or current liabilities and long-term liabilities, it's the same distinction. So 1 year or less, more than a year. So hopefully that helps on dividends, and have a nice day. Thanks.